At the same time, we're watching a broad rally in today's session. It's led by materials, tech, and financials. The 10-year note yield under some pressure today with the yield nearing 3%. Again, the 10-year note, I should say, under pressure. Yields are a little bit higher. Joining us now is Johnny Fine, Goldman Sachs' head of investment grade syndicate in the Americas. Johnny, what I think the headline today is that the Fed stopped spooking the markets. We had how many Fed speakers this morning? And just heard from Fed Chair Powell this afternoon in the last hour. He was talking tough on inflation. We're going to keep expeditiously raising interest rates, going past neutral, whatever it takes to fight inflation. And guess what? The market is still rallying. So has the market gotten past all this?
So I think you're 100% right, Sarah. We're moving to a point of inflection with respect to Fed speak overall. Really, since the beginning of the year, every time there's been an FOMC member who's had the opportunity to engage the public, they've taken the market to a more hawkish position than it was previously. I think today, and maybe in the last kind of couple sessions, is the first instance of effectively the Fed saying, yeah, the market's got it right. It's now priced appropriately for what the Fed is likely to do.
So what does that mean? Does that mean that you should be buying bonds now? It's not working today, but that's sort of been in the last week and a half, the change.
Well, I think most importantly, it might be signaling that we're nearing the end of a very intense bout of fixed income volatility. But one thing that we've been looking at since February is the MOVE index, the volatility of US Treasuries, the sister cousin to the VIX index, and what that does for the S&P. That's been trading at extraordinarily elevated levels that we haven't seen in a dozen years. And even at the start of the pandemic, where we did see a brief spike higher, we're now not even trading that far from those levels. I think one of the key unlocks from here is going to be a tampering down of rate volatility and that MOVE index moving lower.
That could be good news for stocks. You know, Johnny, a lot of talk of recession lately, and are we going into one, and how soon is it coming? The credit market would be a key signal here. What do you see there as far as recessionary risks and warning signs?
So I don't think the credit market is really calling for a recession as I see things over the course of this year having developed. Yes, credit spreads have been widening in investment grade over the course of the year, but they've done so in a very low beta manner to the equity market overall. It's sold off less meaningfully than one would expect on down days. It's actually rallied less meaningfully than one would expect on up days. And so I think what that is telling us is that corporate America did such a good job in fortifying its balance sheet coming out of the pandemic that ultimately recession risk is low. Now, we've taken down our growth forecast for next year, as I'm sure that you've seen, roughly 1.5%. We see a 1 in 3 shot of there being a recession next year, as does the market. It's clear that the Fed has a very tough job to land the plane here overall, but I would say there's no canary in the coal mine insofar as credit is concerned.
So companies still can finance? I know it's been affected somewhat, having to pay higher rates.
So obviously the cost of financing has gone up from both the rate component and the credit spread component. But to put it in context, we financed around $680 billion of investment grade credit in the US alone since the beginning of the year. That's the third busiest start to the year that we've had on record. Markets are open. Deals are getting done. There's strong sponsorship. Yes, costs have risen, but overall, there's certainly been no cessation of activity. There's been no freezing over of credit markets. The investment grade market from AAA down to BBB minus, alive and kicking.